Speaking of wild years, Disney, the latest streaming service to hike prices and crack down on password sharing. The media giant shifting focus to capitalize on existing subscribers, with CEO Bob Iger telling analysts on the earnings call that the company is aiming to migrate more subscribers to its ad-supported option. For more details on the call, we're joined by Yahoo Finance's Alexandra Canal. Ali, what stood out to you from the call?
There were quite a few things that stood out. I think number one being the fact that we are going to see price hikes again for the second time in a year. And I think for most consumers, they're thinking to themselves, what the heck? We now have all these streaming services and they're getting more expensive. And these price hikes are pretty significant. The price of Disney Plus, that's going to go up by 27% to $13.99 a month in the US. That's up from the prior $10.99. And remember, when Disney Plus first launched in 2019, that price was $6.99. So now we're pretty much double from those levels. Hulu, meanwhile, those prices are going to increase by 20% or $3. So, this is coming as Disney is trying to pare down some of those losses, especially those streaming losses, and increase those profitability levels. That did happen in the quarter. Disney reported streaming losses totaled $512 million in Q3. That's about half of the $1.1 billion loss that was reported in the prior year period. And that was also significantly ahead of estimates. So a positive thing there, but probably a negative for consumers, is the fact that we will be seeing a Netflix-style crackdown on password sharing. So to me, this is a sign of what's to come from all the streaming giants. Bob Iger did talk about this a bit on the call. Here's more of what he had to say.
We are actively exploring ways to address account sharing and the best options for paying subscribers to share their accounts with friends and family. Later this year, we will begin to update our subscriber agreements with additional terms on our sharing policies, and we will roll out tactics to drive monetization sometime in 2024.
So 2024, the password sharing crackdown coming to Disney Plus users. And then another key thing I want to mention is the parks business. Bob Iger did say that there's been some softness when it comes to Disney World in Florida. And that's due to a few things. One, the fact that we've seen tourism slow. We've also seen a strong US dollar that has discouraged travel from international guests. In addition to the fact that we've seen a decline post-pandemic when it comes to that pent-up demand. So not as much demand as there used to be. That being said, though, we did see the parks, experiences, and products segment surpass revenue expectations in the quarter. Operating income also came in strong, $2.43 billion. That's ahead of estimates and also ahead of what we saw in the prior year period. International parks, a large part of that story. And then finally, when it comes to ESPN, we didn't get too many details on that, but we do know that Bob Iger is super committed to bringing ESPN fully over the top as a direct-to-consumer streaming service. He talked a little bit about that Penn Entertainment partnership, about how Penn was very aggressive in their approach, and that's why they went with them. So we'll see what's to come from that.
All right, so we're going to know your vibe check from this call.
I would say the vibe check is fine. It's fine. I think from an investor perspective, we've seen shares go up. I do think it's encouraging that we have losses going down, and they do seem adaptable, right? Disney seems not to be so tied to what they said they were going to do, like sports betting, for example. Now they're embracing that. So they're willing to pivot in the name of profitability and in the name of paring down those losses. I do wish we got a bit more color and a bit more detail on ESPN, possibly some of those strategic partnerships. Bob Iger, he didn't spill his guts like we've seen him do in recent interviews. So I wanted a bit spicier of a call, but overall we did get.
Name me the last spicy earnings call you guys heard besides Tesla. Tesla x Tesla.
Spicy?
Yeah.
That's true.
And for Vibe, we also have Vibe Check the shares, right? The shares are up 2.3%, which I think also is
contributes.
Fine.
Yes,
it's
which
fine.
is fine. So
last quarter.
That's my take.
Yeah, that was spicy.
That was spicy?
Yeah, it had spice.
The news was spicy.
Had seasoning.
Okay,
yeah.
All right, fair enough. All right, Ali, thanks.
We're going to come back and rate the spiciest earnings calls.
I'm just trying to manage your expectations,
That's true.
guys.
I know.
That's all. Thanks so much, Ali. Really appreciate all your coverage of Disney and doing double duty on CPI today. Yeah. Also, if you look at YahooFinance.com. Yes, exactly.